In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning once again, Market Rebels. And yes, I did say morning. Normally it's 4 o'clock on the closing bell when we do Coach's Corner, but it's about 8:30 here Eastern Time. And we're doing this because we're going to be following up a webinar with Jeff Garbaz and Mark and Pete. So the topic here is going to kind of help you to understand some of the things I'm talking about. So we thought that would be kind of a good topic for today. I'm going to tell you what it is just yet. But Stu,
yeah,
we had a big couple of earnings last night. What happened? We had NVIDIA and Salesforce.
NVIDIA and Salesforce. So NVIDIA is, where is NVIDIA trading? Is that still on? Yeah, it's still on. Let's take a look here. So NVIDIA is trading up, it's funny. The implied move was around 7%.
Yeah, we looked at that.
It's up about 7%.
Isn't that something? Yeah.
And CRM was earlier. That seems to be down a little bit today. But there was a big announcement about the court ruling on the tariffs.
Yeah, saw that too. But so how are the futures looking on the Dow?
Futures, the Dow is, they're only up about 58, but the Q futures are looking 40.41, and the Q futures are higher, 260, and the S&P futures are up 41. So we're looking up.
Yeah. So we should have a pretty good opening here in about the next 45 minutes. But for today, another cool topic for everybody. So let's get started into it. And before we do, please remember, go to marketrebellion.com/get started. You can find all kinds of great videos, articles on topics just like this. So, Stu, for today, I always try to keep you on your toes here. Stu doesn't know what these topics are. But question is for everyone, this is our Chalk Talk question to kind of give you something to think about as we go through the presentation. We'll answer it for you at the end. But is a large short interest ratio bullish or bearish?
Can I give you my standard answer?
You can.
Yes.
Yeah, exactly. So again, now if you just watch the webinar that we had again with Jeff Garbaz, he runs the squeeze play. And so we thought this would be a good topic to talk about it because a lot of people say, yeah, it's really cool, but what in the world is a short squeeze in the first place? So I'm sure they probably did some explaining on theirs, but we thought it would also help you to talk a little bit more about it in detail here. So that is our topic. What is a short squeeze? We're sure you've probably heard the term. You'll hear it on CNBC. You'll certainly hear a lot of us talking about it, and certainly Jeff Garbaz in that group talking about short squeezes. So what is it? How does it come about? Why is it important? So let's start with a look at our risk graphs too of long shares of stock. If we buy shares of stock for 100 right here, what happens? We get dollar for dollar up. We get dollar for dollar down. So the risk is down here. We have unlimited downside, at least to a stock price of 0. right? In the business, we still call it unlimited, but it does have theoretically or technically a cap at zero. So we get this dollar for dollar line like this with a long shares of stock. However, if we were to short shares of stock, we get the opposite. We're doing exactly the opposite thing. Instead of buying shares low and selling them high, we're going to start out by selling high and buying low.
You
So
know
you
what
can,
I just thought of, Bill? Little
what's that?
kind of funny, dumb thing here. Unlimited, you know, you were talking about unlimited downside. You said in the business, we call it unlimited, but it
Right.
really has a cap and it's down to zero. So it's like if you're trading a $10 stock, it's $10. It's
It
kind of
is
limited.
$10. Yep.
And even though it's unlimited, it's limited. And it's like, okay, $10 is $10. But if you're trading the $500 stock,
Right.
it's really unlimited, isn't it? I mean,
Well,
five.
I think when we say it's unlimited, what we're saying it would be very unusual, at least in a short term, for it to go to zero.
Yeah, exactly. That's what I'm
That's all
saying.
we're saying. So even a
It's
$10 stock, you might say it can only fall 10, but that's still 100%
it's
of the
100%.
company's value. So
Yeah,
even if really bad news comes out on a $10 stock, it might be down $2.
might be down two, it might be down three, or might be down four, or if it's
Right,
a
but
buy.
it's not going to be down 3 or 400
Right.
because it just doesn't have that far to
Yeah.
move.
That was my
So,
point. It's
so
like this whole unlimited thing. It's really a kind of a perspective thing, but
yeah, it is. But
that's
we
not the point. The point is, there's where's it going to stop?
Yeah. And
You don't know.
so chances are, if you're holding shares of stock in the next 30 days or 6 months, it's probably not going to be zero. So then
Mhm.
the question is, well, how far can it fall? Well, now we're going to say, I don't know. And if we don't know, that's kind of saying it's unlimited.
Yeah.
So now let's go over to the short side. If we short shares of stock, we'll look at the details of what that means in a moment. But you're going to look like this. It's just the opposite. So now we can see that the short seller profits if the stock falls. See, in order to get this red line above zero, we need the stock to go to the left. It's got to fall, and that that puts us into gains. And the further it falls, the more profitable you are.
And we can in this crazy world that we live in, we can sell stock without owning it.
Yep, we're going to talk about that in just a moment.
There's more behind that, but we can't. Well, just like options, right? You don't have to own an option to sell it. You can sell it short,
Yeah.
and stock you can short stock as well. You can sell it before you buy it, or you can buy it then you can sell it, or you can buy it never sell it, or you can sell it and sometime in the future you probably have to buy it. But there you go.
So we can see that as it goes up, we make money in the long stock. If it goes down, we lose. And it's just the reverse for the short seller. So you can think of the short seller as a trader on the opposite side of the buyer. But that's not really technically true. It is true for options and for derivatives. You absolutely need a short position for every long position. But for equity, you don't. Because if, let's say, if this is Microsoft, if it rises $1, far more people make money than lose money. If that happens in a derivatives market, it's flat. Because for every gain, there has to be a loss. So again, you can think of it as the trader on the other side. If you buy shares of stock, you could think of it as somebody shorting. It probably isn't. But a short seller is going to sell shares just as if they owned them. And as far as the broker knows, or if you buy the shares, you have no idea if they're coming from a short seller, and it just doesn't matter. You own the shares. So the point that I wanted to show right now is that for a short stock position, we are bearish. We want the stock to fall, and if it rises, we can end up going into some very big losses. Now, what's the big difference here, Stu? We have unlimited upside risk, and when I say unlimited here, it is truly unlimited. There's no limit on how high a stock's price can go.
Yeah, GameStop.
So a short stock position, when you want to talk about some real danger in the market, it's a short stock position. And then when we add the short squeezes or the potential short squeezes, you'll see why. So let's talk a little bit about a short sale. How would you short shares of stock? This is a confusing topic for a lot of people. As Stu just mentioned, what you're doing with a short position, whether it's a short stock position or a short call. If you're doing a covered call, you say, I've got shares of stock, I've sold a call. Well, you don't own that call. It's not in your account. That's a short position. You've sold something you don't own. If you sell naked puts, you've sold a put that is not in your account. So that's really all that's happening. And when you sell these things, you're going to go, all right, well, first of all, where do we get them? How can I sell something I don't own? Well, in the stock world, you have to borrow it. And might sound like a complicated process, but every broker is set up to short shares. Just as easily as you can click buy, you can click sell. And if they're not in your account, you're now short. Now, of course, there are margin requirements that you'd have to be able to meet to be able to click that button. But assuming that you can, it's really just that easy. Just click on sell. And when you do that, you have the obligation to return those shares because you've borrowed them. In the business, we would say you're just buying them back at a later date. So why would we do this, Stu? Why would we maybe sell shares now and want to buy them back later?
Well, I guess because we think the stock's going lower.
We
Same
think
reason
the stock is
it's going higher.
opposite of the reason that we're buying. Yep. So this is a bearish outlook. So again, you're really doing the same thing as a stock buyer, just in the reverse order. You are selling high, or at least what you think is high, and buying back low. The stock buyers buy low and sell high. See, in both cases, you're buying low and selling high. With the short selling, you're just doing it in the reverse order. So yes, what we'd like to do, the idea is that we're maybe going to short shares at 100 and buy them back at 90. And therefore I can keep the $10 difference. Now, generally, there is no time limit to buy these back. That's assuming that you can meet any margin calls, which we'll talk about here in a second. That's really the only constraint. But there is another one, Stu, isn't it? You can get a buyback.
You get you get a buy-in. It comes under the reg show which I believe came in around 2005. It has to do with the hard to borrow.
Yep.
Generally your ticker would be very available to borrow.
Very liquid.
Right. It's stock lending. It's a big business in the brokerage world. But every now and then a ticker becomes, for a variety of different reasons, unavailable or very difficult to borrow. And then there's a fee involved in that. And you can really only borrow it for a limited period of time. If it falls under the reg show, I believe these days it's 13. There's a 3 heads up, and then the 13-day, you got to kind of cover it, right?
You got to cover it, yeah.
Got to cover it. And that could as well create some sort of
that can cause some problems, right? You might think, hey, I'm bearish on this for the next 6 months, and you could technically get a buy-in a couple of days later, just blow that whole thesis right out of the water.
The broker's just going to step in and buy it on your behalf, and all of a sudden your short position is gone, and they're not even going to tell you what price they're going to pay. They're just going to buy it.
They're just going to tell you, they're just going to do it.
They'll give you an opportunity to do it, but if you don't, then they'll go.
Oh, yeah, they'll come in and do it. So the thing that you have to realize is that, excuse me, whenever you open up a margin account, part of the deal is that you are giving the broker the right to loan out your shares. Now, that sounds kind of odd. You say, who in the world would do that? Everybody in this room does it if you deposit money at a bank.
Yeah.
Right? You take $1,000, you deposit it at your bank. Do you think they stick it in a little drawer with your name on it and say, don't ever touch it? Of course not. It's out the window. So when you look on your brokerage statement or on your online, you say, oh, there's my $1,000. It's not there. It's just a computer entry saying really that the bank owes it to you. It's been loaned out. And that's really all that's happening. Yes, you might say, oh, look, I've got 100 shares of Microsoft. No, you don't. It's showing, let's say if you have an account at Schwab, those shares are actually held at Schwab for the benefit of, and then your name. And so they'll say, okay, we're going to show you a credit of these shares on your account. But believe me, they are getting loaned out. Now, if you don't want a little side note, you could move them into what's called the type 1 account, or the cash side, where they're not allowed to loan those out. So at any rate, the point being is that the broker, let's say that Stu wants to short 100 shares of Microsoft. Super ridiculously liquid stock. That's just going to go off. You'll never have a buy-in, never going to be a problem. But let's say it's a less liquid stock. There's just not a lot of people that own it. And my shares get loaned out. Of course, I don't know that's happening. It's going on behind the scenes. Stu turns around and shorts them. Now, I decide that I want to sell my shares because as far as I can see on my screen, they're there. But the broker says, holy smokes, they're not here.
Well, let's go borrow them from somebody else. Oh, this guy doesn't have them. Oh, wait, this girl over here doesn't have them. This person does, but it's in type 1. Where are we going to get them? They got to go to Stu and do a buy-in. Just say, look, we need the shares back. So that, again, just be aware if you're shorting shares, that is something that can happen. It's fairly rare, but if you see on your broker's platform, it will usually say HTB, and that means hard to borrow. And they're just giving you a fair warning saying, look, these could be subject to short squeezes. Any stock can, but definitely a hard to borrow. And they're also far more likely to be bought in.
And you know what else is kind of funny? Not really funny. It's tragic. That if you own shares and say you're on margin, they're charging you margin interest.
That's right.
And they turn around, they lend them out. They're getting paid
by that other. That's right.
Borrowing them a fee. And you're just sitting there, getting zero benefit, paying for somebody else.
Okay, so let's another little side note here I think is very interesting. Should shorting be illegal? You hear this a lot, and people will say, well, you're betting against the success of U.S. firms, and you're putting downward pressure on stock prices. And this should really just be banned because all of these short sellers are just wreaking havoc on the market, and they are the vultures of the capital markets. They should be banned. Is that really true? Well, the answer is not. That's just a bad argument. It's not understanding one of the functions of a capital market. One thing is price discovery. We're trying to say, what's the share of Microsoft worth? There's nobody on the planet who knows. You could go to 10 different CPAs. They would all give you 10 different answers, probably reasonably close, but they would be different. So we're saying, how do we figure out what it's worth? Well, let's just throw it out there for the world to see. If somebody thinks it's undervalued, how can you make money from it? Well, by buying it. And then therefore, if a lot of people think it's undervalued, the price will rise to what we think is a more fair value. However, what if you think it's overvalued, Stu? What could you do?
So
not a single thing unless you can short shares. Right. And so if you think of it like a voting system, which is really what it is, if you vote that the share of Microsoft is too low, you can buy. What's the incentive to do it? You're going to make money from it. So you have a very powerful incentive to say, I vote that the price is too low. But you also have to be able to vote that it's too high. Otherwise, stock prices would generally have a much, much higher upward bias because nobody could ever vote that they're too high. So in a way, not in a way, in a definite way here, they are protecting you. Because think about this. You go, oh, here's this stock I've never heard of. It's trading for $300. Let me buy it. And it's really only worth 80. And you step in it at 300 and it quickly crashes to 80. Was that fun? No, but if we had allowed short sellers, it probably never would have gotten to 300. And so you have to realize it's just it's a voting system. So that's a little side note. If you ever hear people saying that shorting should be illegal, it actually serves a very important economic function. Quick reminder before we continue into some of the details, marketrebellion.com/get started can definitely get you on your way to making better decisions. So remember earlier I said that that generally there's no time limit provided that you can meet margin requirements. So for any type of margin trade, generally you have to deposit 50% of the trade. So what's called Reg T, Regulation T. And that's true if you're buying stock on margin or if you're shorting it. Now, obviously, you're going to get a credit from this short sale. If I sell 100 shares at $100, that's what? $10,000 credit. Remember, I'm selling these just as if I owned them. So I get this nice big fat credit of $10,000 to my account, but I also have to post 50% of my money. So the broker is going to, it's called kind of segregating or putting it on margin. They're going to hold back $5,000, let's say, from your margin account, or from your cash account, your money market, or just from your stock buying power. So you have to somehow post this. You got to have some skin in the game to say it's to protect the broker. Just in case it goes against you, they want to have a little bit of a cushion here. So your equity in this position equals this credit minus the market value short. So I know it can sound confusing, but here's the way that it works. Let's say that you short 100 shares at $100 per share. Again, you get a $10,000 credit. You have a $5,000 margin requirement. So what's happening is that your credit is going to be $15,000, $10,000 from the sale of stock, and $5,000 of your own money. How much value did we short here, Stu?
10 G's.
10 G's. We subtract that out. What's the equity? 5,000. Right now, this 5,000 equity is coming from our money. And we can see right there is 50%. The equity divided by the market value short is 50%. We have to start here. Now, the reason for shorting, let's start with the good side first. How do we make money? Well, if the stock price falls, your equity rises. So let's go back. We have this $15,000 credit. Let's say the stock falls down to a value of $9,000. Okay, it's trading for $90 a share. And that was your reason for shorting it. So the credit that stays the same, 15,000 minus the market value short is now 6,000. So now notice that your equity is 66%. And your broker will show that. It will show your margin equity percent. So we just have to stay. We started at 50. Right now we're looking good. We've built up some equity. But take a look at the leverage here. The stock fell 10% from 100 to 90. What happened to our equity? Went from 5,000 to 6,000. It went up 20%. Why did we get this twofold magnification? Because we have 2-to-1 leverage. We only paid for half of the position or financed half of it. Right? We got $10,000 worth of credit, but we only had to post 5,000. So so we get this nice leverage. Now, again, a little side note, generally speaking, in the stock market, that's the best you're going to do. There are cases where you can get 4-to-1, but in the options, 3, 4, 5, 10-to-1, 20-to-1 is nothing. So that's another, if you're looking for leverage, you can't even come close to touching it in the stock market like you can with the options market. All right, so that's the good side. We can see now why we make money if the stock price falls. But what if it goes against us? If the stock price rises, now the equity falls. Now, I said earlier we had to start at 50%. That's a starting line. They give you a little bit of wiggle room because it would be really annoying if you had to keep it at exactly 50 every day. You'd be sending a few pennies to them just because the stock ticked down a little or ticked up a little bit. So they say, okay, we're going to allow it to fall a little bit. Now, generally, if your equity falls below 30%, you must deposit more funds. I've highlighted 30% because the NYSE, New York Stock Exchange rule, is 25%. I don't know of any brokers that do 25. They pretty much all do 30. Because brokers are allowed to make rules stricter. Nobody can go below 25%, but they could. So you might find your broker says, we require 35 or 40 or 50, or we don't allow you to short this stock at all. We'll let you do other stocks. They're allowed to do that. So competition pretty much keeps this at 30%. One of the main ways that brokers make money is to loan stock. So if they're saying, well, we're going to charge 40% because it's safer for us, now everybody's exiting and going over to another broker. So I think it's safe to say, if I had to pick a number, Stu, I bet 95% or more have what's called a house percent of 30. Just realize that it doesn't necessarily have to be that. So the way the math works out is your market value short, we take this credit divided by 1 plus the house percent. So if your house percent was 35%, you would divide by 1.35. And that gives us this 11,538 number. So let's go back. If we have a credit of 15,000, and if the market value short rises to 11,538, what's our equity now? 3461.
Not as much as it was.
Not as much as it was. And what do you suppose this ratio is right here? 30%. All right, so now we are right on the edge of a margin call or a maintenance call. So let's say that instead, let's do another scenario where the market value short is 12,000. Right, so we're definitely into, because 11,538 is the line in the sand. We've crossed it. We now have equity of 3,000, which is what? Yeah. See, they're going to tell you to bring this up. Now, in the stock world, we just need to bring it back up to 30%. Another little side note, in the futures world, you have to go all the way back up to the initial margin. They have what's called variation margin, but you have to go, if you end up with a margin call, you have to go all the way back to start. So that can really be a lot different in the futures market. But for the stock market, we just need to bring it back up to 30%. So in this example, what would we have to deposit? $461.
So the concept, everyone, it's not really that much different than buying stock on
It's
market.
not exactly right, just the opposite direction.
It's just the other way, right? You sell something short and it goes up, goes against you. They want you to put more money up. That's basically what it comes
That's all it
down.
is. Yeah. They're just saying in case this gets away from you and you go negative equity and you say, forget this, I'm going to just close my account and walk away. Well, now the broker's on the hook for that.
Yeah, they're not in business to.
They're not in the business of being a loan shark and saying we're going to come shake you down for it. They're saying, look, if you can't hold the maintenance, we're going to shut you down. So if you think back a few slides when I said generally you can hold a short position indefinitely. That's assuming you don't get a buy-in, but if you're shorting a big name stock, that's never going to happen because they can always find somebody to loan it. But this could obviously happen where you just go, I either can't meet it or I just don't want to continue meeting it. And then they're going to close it, and that would be for a loss. Now, again, take a look what happened here. The stock rose 20% from 100 to 120. So that's a 20% increase. What happened to our equity? It went from 5,000 to 3,000, which is a 40% fall. So again, we're seeing it's this 2-to-1 ratio. So not only are we profiting if the stock goes down, but we're doing it in a levered fashion. And I think most people know that stocks usually fall much faster and harder than they rise. We can get markets that melt down. They very rarely melt up. And so that's one of the big appeals of shorting stocks. You short a $500 stock and it has a bad earnings income, like think of UNH. I mean, the amount of money you can make in there is insane, but there's also a lot of risk.
Ton of risk.
Yep. So now let's talk a little bit about a short interest ratio, sometimes abbreviated SIR. And this is the number of days it would take to cover the current short positions, assuming the average volume. So for any stock, there's, like Microsoft has something like 8 billion shares outstanding, what's called the float, but a percentage of those will be short. Every stock in the world has some kind of short exposure. So the question is, how big is that? Well, let's look at a simple example. Let's look at a very small stock that has 1 million shares short, and it has an average daily volume of 200,000. Well, what we're saying is that if the volume stayed the same, average, and all of these short positions tried to cover, it would take about 5 days to clear out these shorts. Now, in reality, what happens? It gets blown out in a day or within hours because people aren't going to say, we're going to watch this thing go up and up and up. We're just getting our heads handed to us. We're getting margin calls. Let's just exit. Everybody runs for the exits at the same time to cover this, and that is a short squeeze. That's exactly what's happening. The stock makes a fairly aggressive move. Might be over a few days, might be 1 day. Big gap up on earnings, and it continues to rock. Why? Because all the shorts are going, holy smokes, let's run. So as some benchmarks, if you have a short interest ratio above 10%, that's definitely high. We've seen some of them in some of our UOA that were, 30, 40, 50%.
40%.
50, yeah. They're just insanely high. If you see something that's like 0.5, don't go, oh my gosh, they're bearish on this. There's always going to be short interest in there.
For a number of reasons. And it could be other than
exactly. It might not be just for bearish. Exactly.
I think this, yeah, right. I mean, desks all the time sell stock against option positions and future positions as well, just as a hedge. And that becomes part of the short float also.
Exactly. So if we look at, let's go over here to finance.yahoo.com. I'm sure a lot of people are saying, where can I find this information? There's a lot of places on the web. You could probably just go to Google and say, what's the short interest ratio on Microsoft? It will probably land you on a page like Yahoo or any number of sources, FinViz. But we just wanted to at least show you how to find that.
0.78, actually. I'm looking at it right now.
Oh, is it really? Pretty good guess. So just type in finance.yahoo.com invest.yahoo.com. You can also go to Yahoo and click the finance link, but this will take you right to it. And if we go there, there we go. So we'll pull up Microsoft. And now we're looking at all the data, lots and lots of data. It's really a great page. Over here on the left, we can download historical data, statistics, profile, what does the company do? What do they own? Analysis, all kinds of things. But click here on statistics. And then we need to scroll down. And over here, shares short as of 5/15. Now, what's today, Stu?
529.
5/29. So you can see that these aren't, really up to date. Now, if you're in our service like with Squeeze Play with Jeff Garbaz, they are updated daily. I don't know of any websites that update daily, at least for free, but it can at least give you an indication if there, or at least have been recently, a big short position in here. So there you can see the short interest ratio. I'm sorry, the short ratio, 2.5. So they're telling you the percent of float is about let's call it 0.75%. 0.77. That's small. And like Stu said, that doesn't mean that people are bearish on it. They could be, it could be a hedged position. Who knows? Gamma scalping. There's lots of reasons that it could have short positions without it being bearish. But here's our short interest ratio. So again, remember how to interpret that. Should we expect that that's going to take 2.5 days to clear out? Nope, probably going to take a matter of hours.
Yeah,
it's just going to be a big mad.
I was going to comment on that, right?
Yeah.
That's a very dynamic number. I mean, if the pressure is building up, and now all of a sudden people need to buy it, it's not going to be 2.5 days.
And that's why it's called a short squeeze. It just comes firing out of there. All right, so that's the whole idea, again, of our short squeeze. The short interest is a bearish outlook. But eventually, it's got to be bullish. Why? We know for 100% certainty that they're going to be buyers. See, I could know Stu for a long time, and I don't know that he's ever going to short Microsoft or any stock. He may never. But if he's short shares of Microsoft, what do I know? I know with 100% certainty he will be a buyer at some point.
At some point.
So you have to say, just because you might be bullish on a stock and you see that there might be a relatively high short interest, let's say 15 or 20% or percentage, it doesn't necessarily mean that you're wrong. It could actually be a benefit because all of those people are potential buyers in the future. And if your thesis is right and it goes up even a little bit, it could be a mad dash for the exits, and then you could see a short squeeze. So again, if the stock aggressively rises, the short positions rush to cover the shorts. And what this can also do, again, part of why it's a short squeeze, is it creates what's called a positive feedback loop. So as the stock is rising for other reasons, short sellers the people who were short come in to do what? Cover it. That makes it rise even faster. That makes other people go, my gosh, it's rising, let's get in. And it makes the other shorts go, oh my gosh, I can't take it anymore, let's go in and buy it. Everybody's rushing in to buy it because it's rising. And the more it rises, the more they buy and the more it rises. So that's what's called a positive feedback loop. It just feeds on itself.
Not to mention the short gamma guys that are getting squeezed.
Oh, that
now need to buy stock because they're getting short delta on the way up.
On the way up, and accelerating that short position with the gamma. Yeah, that would actually be we could do a topic on that all by itself. But in the options, it can be even far more deadly because of gamma.
And the big picture, Bill, is look, think about last month. Everybody in the world, bearish.
Yep.
On the bandwagon.
Quick.
People are shorting stock, institutional desks. They're shorting stock. They're shorting stock. You have hedge funds that certain kind of hedge funds. They're long, they're short. Sometimes they use stocks, and other times they don't. And and now all of a sudden, like the entire market is like shorter than it was before.
Yep.
The short interest is up on the overall market, and then we get this big uptick, and it's like, whoops! All of a sudden, got to cover.
Yep.
Wrong. Got to buy it. Now you start now they're start chasing it, and it
Yep.
just, like Bill says, it just kind of feeds
It's like
on
a
it.
snowball rolling down the hill,
Yeah.
right? The further it rolls, the bigger it gets, the faster it goes, the bigger it gets. And that's exactly what's happening. And again, that's why it's called a short squeeze. So I've often made the analogy, think about it like if you take a watermelon seed, put it between your fingers and pinch, what happens? It comes flying out of there, right? You can shoot those things 20 feet across the room. That's really what's happening. It's just getting this squeeze from buyers and short covers all at the same time, all trying to get to the exits to say, I want to get out of this position. And buyers are trying to get in, and it just becomes like a watermelon seed. It can absolutely fly through there. So that is the short squeeze. So again, if you just came off the webinar with Jeff, that's really what his service does. He just focuses on, it's a really slick software, proprietary software. I'm sure you saw it on the webinar, but that's what they look for. And then they look at it, compare it to seasonality and what's happened with the stock in the past. And is it a likely candidate for a short squeeze? So that doesn't mean that you have to play it just for the short squeeze, but it's a cool service because you might say, hey, the stock that I'm long, let me look at this software. Wow, it's actually got a high ranking. They give these stocks ranks about for a short squeeze. So we just want to make sure that everybody at least understands the mechanics of a short stock position, why we have them in the market, margin behind them, and most important, what is a short squeeze? So Stu,
Yeah.
let's answer our question here.
Okay.
Is a large short interest ratio bullish or bearish?
Yeah, my answer hasn't changed, Bill. Yes.
Your answer is yes. I came up with, I said, in the short term, you could interpret it as bearish. That's why people are shorting it. But in the long term, we know that it's really a bullish sentiment eventually. They are all potential buyers. Now, where could this backfire? Right? That doesn't necessarily mean in the long term it's going up. Maybe the short sellers are right, like with Bear Stearns and with Enron, right? They came in droves. And the more that short interest ratio went, the further that stock fell and eventually it collapsed. So you have to realize they could be right. But if you're dealing with your bigger name stocks that might just be going through a bad period and you see a lot of short interest in there, think of something like maybe like UNH. And you might say, are they going to turn around? Some people will say, well, yeah, I have a feeling they're going to turn around. You might want to check the short interest because that could be another little potential tailwind at your back there. So Stu, any closing comments there?
Well, yeah, so it's a mistake in my, my belief is it's a mistake to look at any one indicator. If you take a look at the short interest, or if you're taking a look at the
Right.
SIR and say, oh, this stock's going down, I'm going to start buying, but it's not a good idea.
That's a good point. It's one piece of the puzzle. It
One
might be
piece of the
completely
puzzle.
meaningless. Also, remember, you might be looking at it a month with a lag of a month. You might say, wow, it's got 20% short interest and now there's none. And you're sitting here because you're kind of driving, looking in the rearview mirror. So if you're going to make serious decisions based on that, try to find something that's very current. Stu, another question for you. We talked about being bought in, and I know as market makers, you were kind of forced to short shares all the time.
Yeah.
Did you ever have a buy-in from a short position?
Oh, did I have buy-ins? I had massive buy-ins. We were
you
actually,
did. Oh, like any names you remember?
yeah. So there used to be, it doesn't really trade anymore. Sears turned into Sears Holdings
Holdings, yeah.
Its name, right? SHLD.
As a shield.
It was about $100 stock at the time. And there was a play going on in there, and we were short hundreds of thousands of shares. And we would get buy-ins. They would come in around 5:30 in the afternoon. They took place between 3:30 and 4 in the open market. And at 5:30, we got the report. Sometimes we got bought in on 30, 40, 50,000 shares. And then all of a sudden, and they gave us the price. We didn't pick the price. They gave us the price. And, all of a sudden, we're now long 50,000 shares of Sears Holding coming in the next day. And it's like, okay, now what do you want to do, guys?
So they would do the trade and just tell you what happened as opposed to saying we're going to do it?
Well, they would tell us that there was going to be a buy-in.
Oh, I see. Okay, so they did tell us.
And yeah, then they would just go ahead and do it.
Yep.
They had to do it. Right. And sometimes to even exacerbate the issue, sometimes you had to go into the if there wasn't enough stock to actually buy in the real market, they had to go into the cash market,
Yep.
same day settlement cash market, which could be really bad. I mean, it could. I remember this one trader I knew. He was short stock at around 40, and he got bought in the cash market after hours at 50 on a lot of shares. That guy actually went out of business because of that.
Oh yeah.
So you got to know the risks. It's like anything else, everyone. You got to know what you're up against, and things will hit you from places you never even thought possible.
That's why we've heard that saying before, didn't we? From Steve Levick,
Love it.
one of your buddies down there in the trading floor. We interviewed him a while back.
Yeah.
He closed by saying, "Know your risk." And that's one of the reasons why we love options, because you can define your risk beforehand. We can't predict the market, but what we can do is define the risks to say, no matter what happens, I know that this is going to be the worst. And like Stu said, lots of things are going on behind the scenes that you can't control. So
Right.
understand your options. Check us out, marketrebellion.com/get started. Check out Jeff Garbaz and Squeeze Play. And if you're interested in short positions or maybe using it as a tool for many of your long positions. And with that, can't wait for the market to open here in about 10 minutes, Stu. We'll have to maybe get another exciting day here. And we'll see all of you next week at Thursday at 4. And we'll see you then.